Cavaness Realty Institute. Chapter 12. Valuation Process and Pricing Properties. 6th edition, pages 431 to 445. 7th edition, pages 375 to 389.
Appraisal, valuation, market value, and evaluation appraisal.
An appraisal is an unbiased estimate of the nature, quality, value, or utility, based on factual data, of an interest in or aspect of identified real estate and related personal property as of a certain date by a state-licensed appraiser. Valuation is the process of estimating the market value of an identified interest in a specific property as of a given date. There are many types of value, each serving a specific purpose.
Types of value.
Investment value is the amount of return on a certain dollar investment that a property will produce. If an investor requires a 20% return and a property returns $20,000, the investment value is $100,000. $20,000 divided by 0.20 equals $100,000. Insured value is the cost of replacing or reproducing the structure in case of a total loss because of an insured hazard. Value in use is the value of the property based on its usefulness to an owner or investor. The assessed value is normally a percentage of market value. A local tax rate is applied to the assessed value to compute the property tax. Mortgage value is whatever the lender believes the property will bring at a foreclosure sale or subsequent resale, LTV.
Market value.
Market value is the most probable price as of a specific date in cash or other asset for which the property should be sold, after reasonable exposure in a competitive market. With the buyer and seller acting prudently and knowledgeably, and for self-interest and assuming that neither is under undue duress. Financing, if any, is on terms generally available in the community as of the specified date and is typical for the property type. Market value also implies a non-related buyer and seller, that is, an arm's-length transaction.
Evaluation.
Evaluation is a study of the nature, quality, or utility of certain property interests in which a value estimate is not necessarily required. Evaluation studies include the following types: marketability studies, feasibility studies, supply and demand studies, land utilization studies. Marketability studies. This analysis examines whether a property can be marketed given current conditions. Feasibility studies. When considering large-scale projects such as residential subdivisions or shopping centers, investors must analyze the market statistically. They must consider all aspects of the project and compare the data with similar projects. This is called a feasibility study. Supply and demand studies. This principle states that the greater the supply of any commodity in comparison to the demand for the commodity, the lower the commodity's value. Conversely, the smaller the supply and the greater the demand, the higher the value. Land utilization studies. These studies analyze the most productive use of land, including the conversion of agricultural land and the feasibility of land for residential, commercial, or industrial purposes.
Differences among value price and cost price.
Is the amount a particular purchaser agrees to pay and a particular seller agrees to accept under the circumstances surrounding the transaction. Is the total dollar expenditure for labor, materials, legal services, architectural design, financing, taxes during construction, interest, contractors' overhead and profit, and entrepreneurial overhead and profit. There are two types of costs: direct costs, also known as hard costs, and include the cost of labor and materials. Indirect costs are the costs to create and support the project. They include fees for architects, engineers, surveyors, attorneys, and appraisers.
Comparative market analysis, CMA.
A comparative market analysis, CMA, is an analysis of the competition in the marketplace that a property will face upon sale attempts. A CMA is not an appraisal. By using a CMA, real estate agents derive a market value range for a property. The CMA is generally presented to the seller when the property is listed. A CMA considers other properties currently on the market, properties that have recently sold, properties that were on the market, whose listings have expired or have been withdrawn.
Highest and best use.
The concept of highest and best refers to the use of land aimed at preserving its usefulness, providing the greatest income, and resulting in the highest land value. The tests for highest and best use include 1. Legally allowable. The highest and best use must not violate any laws. 2. Physically possible. The use must consider the site's size, shape, and topography. 3. Maximally productive. A property may have only one highest and best use that would allow the maximum use of the property and produce the highest return. This use, for example, could be residential only. And 4. Financial feasibility. The proposed use must produce enough dollars to justify and pay for the construction costs and produce a profit.
This concludes Part 1 of Chapter 12 Course Summary. Valuation Process and Pricing Properties.